All right. Good morning and welcome to the December 2025 update for the Spears & Associates Drilling and Production Outlook. I'm John Spears. I'll be your host for the next 60 minutes, and I'm joined today by Richard Spears, fresh off the plane from Houston.
Houston, Texas, to meet all of our friends yesterday.
There you go. And Richard will be back at the end of the show, joining us for the Q&A part of the broadcast. We're recording this Friday, December the 5th. It's St. Nicholas Day in parts of Europe, so Sinterklaas is coming.
Sankt Niklaus.
Sankt Niklaus.
When I was in Schweizerdeutsch.
This just reminds me that this year, 2025, has been sort of the lump of coal in the stocking of the oil patch, if you ask me. It's also the anniversary for when a flight, I think there were 6 U.S. Navy bombers got lost in the Bermuda Triangle. As a forecaster, I am, keep that in mind, right? Because knowing where you're going, where you might need to go is, front of mind. And that's an example of maybe not getting it right. So,
because that was a disaster. This is also, of course, the eve of Pearl Harbor Day.
There you go. Yeah. So many, many important days. As it were. Here's one other historical fact. So back in 1848, the President, Polk, you remember, confirmed to Congress that there had been gold discovered in California, and it set off, the gold rush of 1849, which, you think about it, that's similar
where the 49ers came
that's
from.
Right, exactly.
All right.
And but you think about the rush into AI stocks over the past couple of years. Yeah. History just rhymes, doesn't it?
So if you were the picks and shovels of the 1849
you would have
gold
been
rush,
NVIDIA.
And it's NVIDIA today, right?
Yeah, right.
Palantir and those
very
guys.
much the same.
All right.
We wake up this morning. Oil is trading. WTI is trading at about $60 a barrel. Brent's around 63. Natural gas prices are around 5. So there's a lot going on in terms of some of the underlying drivers, and we want to use this session today to talk about some of the headlines. What are the factors driving capex decisions by operators this year and next, and what that might mean in terms of measures of activity, rigs, wells, things of that nature. So that's what we're going to be addressing this morning. First part of the session, I'll go through the slide deck that presents some of our thoughts on these points. After that, Richard and I are going to stand for questions. These can be sent in via the webinar chat box. I'll try to get some of these answered during the course of the session.
And the webinars, if you're watching this, you're watching it on either YouTube or you're watching it on LinkedIn.
Yeah.
There may be some other medium. And let's remind people that you can subscribe to the Spears & Associates YouTube channel.
There you go.
Sync up with us on LinkedIn. There's all sorts of ways to... Or just call. Call and we'll tell you what the drilling forecast is.
One other piece of housekeeping, rather than sending out the slide deck as we have in the past, these are now posted to our website for DPO subscribers. They can log in and have access in that fashion. So let us know if there's anyone from your organization who needs to be added to that list, and we'll get that done as well. So
and specifically, the website is spearsresearch.com. It's got lots of E's and A's, but they're always in the same order.
Yeah.
So spearsresearch.com, and you can sign in. You can subscribe to each thing. You can subscribe to all things, and we have I don't know, we have several thousand users on our newly upgraded digital website.
So one other piece of housekeeping before we get into the forecast, I think we should mention that after a period of couple of years, we have decided to bring back our Drill Down podcast. Drill Down 2.0 is up and, we'll be getting it started in the first part of January.
And when you say first part, are you saying like January 1st or January 14th?
The week of the first week in January. Yeah.
I will try to be here for that. Well, and we've been idle. We did 221 episodes. We had 2 million streams of this crazy thing.
Yeah.
And the thing that people have bugged us about ever since then is, why did you guys quit?
Yeah.
Other than the obvious reason that you and
what's
I
the
don't
second
get
most
along.
question? The second most question is, when are you going to get started again, right?
That's right. And so we have just given you the answer to the second
Yeah,
question.
and the timing is because, I mean, correct me if I'm wrong, but the statute of limitations has run out, right? So
That's exactly right. We can no longer be
Yeah.
held and thrown in.
We'll be
we can be accused, but we can't be convicted.
broadcasting from a vessel 12 miles offshore. Yeah, there we go.
With Wolfman Jack.
So, on a serious note, Rich, what are some of the questions you're hearing about? So, we're going to be talking about activity and things like that we expect to see. But what are some of the other top of mind things that your friends have been talking about?
In my notebook here,
Yeah.
I have written down some of the more interesting questions that I got yesterday. We had 45 minutes of questions yesterday at the Petroleum Club after a lunch speech that was sponsored by, in order, the AADE and the SPE yesterday. 250 people, all of our best friends. Great questions, but it was 45 minutes of questions,
Sure.
and then people lingered for another hour and a half afterwards. I've written down some of those. So whatever comes in on the YouTube channel
Right.
during the talk, I'll write those down. But the one big message that I talked about was that how the 4-mile lateral is driving every decision that is all of the M&A related decisions
Right.
of EMP and all the technology and performance related decisions in drilling and completion.
You can trace it all back to the desire to get that done, to get that done better. Yeah.
Getting ready for the 4-mile lateral to
Yeah.
be the standard of the industry.
Okay.
Just like getting ready for the 10,000 foot lateral used to be the approach, and now everybody drills a 10,000 foot lateral. So
Yeah.
now it's 4 miles.
That's 4 miles.
So
it is.
we'll be
Yeah.
talking about that at the end if we have time.
Okay, great. Okay, well, let me get started now on terms of the slide deck, and we'll get you back here short order.
I'll go take a nap.
Okay. Yes, so I want to look at CERT as we initially do look at some of the key macro factors that have been driving the industry and any changes that have come about since we last did this update in September. So, first thing we always address is what's the status of the global oil market. And so, again, on this page, you see on the left-hand side what is going on, what's forecast to happen with regard to change in oil demand. Global oil consumption in this year is around 104 million barrels a day. It's up about 1%. You can see from the chart that we're, the larger, more active regions. China has pitched in with about 250,000 barrels a day of oil demand growth. Other Asia is in there with another 350,000 barrels a day, something like that. The rest of the world has been surprisingly strong, somewhere around 600,000 barrels a day of incremental demand growth in 2025. So despite a lot of worries going back to the start of the year when around trade flows and tariffs and what that might mean to oil or energy demand growth, economic growth, and so forth, world economic activity has held up pretty well, and the forecast is for much of the same going forward. 2026, 2027, 2028 all have about a 1% growth in global oil consumption each of those years, and the absolute number is somewhere around 1 million barrels a day gain. So you do hear from the International Energy Agency over in Paris that growth will be more like 750,000 barrels a day. And you hear from OPEC research that it'll be around 1.25 million barrels a day. These are some numbers. The history and the near-term forecast comes to us from our friends in Washington at the Energy Information Administration. And so they're sort of a middle-of-the-road kind of a thing. But I think that's good news for the oil patch in that demand is more robust than what had been expected, and I can only imagine that that low oil prices will continue to spur growth on the consumption side going forward. The relationship is that there's about a 10-to-1 effect so a 10% increase or decrease in oil prices generally corresponds to a 1% increase or decrease in global oil consumption. And so this year, we've seen, in percentage terms, oil prices fall about 15%. And sure enough, we're seeing a little over 1% growth in oil consumption. So I think that's the kind of thing that we're looking for. And then next year, as you'll see in our forecast, we've got a $60 handle for oil prices, so about a 5% decrease in oil prices in 2026. We think that'll help keep demand growth fairly steady. The problem in the market, of course, is not so much on the demand side, as it turns out, but what's happening on the supply side. And so this year, as you can see from the 2025 stack, that output has really surged. Year-over-year change will be somewhere around 2.8 million barrels a day. OPEC, the red portion of the bar, has increased tremendously from no change last year to about somewhere on the order of about a 750,000 barrel a day gain this year, and there'll be more of changes going forward, more growth from OPEC as we expect to see going forward. The real expectation is that the market gets the oversupply situation in the market will probably be maximized somewhere around Q1 of next year. So that's when the consensus opinion is that oil prices might be the weakest, simply because we're in the lowest portion of the demand cycle, annual demand cycle, in Q1, and we'll have some extra barrels sloshing around the marketplace. But again, after that, there'll be some, relatively a much steadier picture when it comes to incremental supply entering the market, and that'll help, we think, tighten up prices as time goes by. So it was interesting then, just last weekend, we had OPEC Plus meeting, and there were two very important items that they agreed to. The first was that they weren't going to introduce any more new barrels to the market in Q1 of 2026. And so that helped a little bit. Oil prices jumped up $2 or $3 a barrel when that announcement came out. Some of the worry about oversupply got removed. But I think the more important announcement is that OPEC will spend next year, OPEC Plus will spend next year trying to pin down what the maximum sustainable production capacity numbers are amongst its members, and this will help set the stage for any quota setting come 2027 and beyond. So there's going to be an interest on the part of some of the major oil producers to prove up their capacity, production capacity numbers. What this might mean in terms of drilling activity over the next year is not well understood, and we're just beginning to wrestle with how that might impact some of the rig and well numbers that we're forecasting for activity come next year, because I could imagine that in some selected cases anyway, you may see national oil companies and whatnot decide to spend a little bit more money in order to prove that they have the capacity to lift output and thus qualify for a higher quota come 2027 and 2028. So that's something we're going to be trying to pay particular attention to over the next few weeks or months, and see what that might mean to the forecasts that we're putting together. On the gas side, again, domestic gas consumption continues to rise. It's up on the order of 1.5% this year. We've seen some growth on the power sector side, some weather-related growth in terms of residential and commercial, and that 1.5% kind of growth rate number is, I think, what we would expect to see next year. When you look in aggregate and add what is happening on the export side. So export numbers are up on the order of about 15% this year. Their net exports are expected to grow around 8% next year. So when you add the 1.5% growth rate numbers on domestic consumption and the 8%-ish numbers on exports, you get an aggregate demand growth of somewhere around 2.4, 2.5% next year. So we're looking at, again, for a very mature industry, low single-digit growth is a good news story. And in fact, again, the market will, these kind of growth numbers will mean that suppliers will be stretched to meet the incremental consumption demand figures that we see in this forecast. And so I think a prolonged period of higher natural gas prices is probably in the cards, assuming weather cooperates and we don't have balmy days in the middle of January in Pittsburgh anymore. So from a commodity price standpoint, then numbers, here's what we're using to underlie our forecast. So oil prices this year will come in right around $65 a barrel, down about 14% from last year. We're using a $60 handle for WTI prices next year, and then a bit of a growth after that as the market tightens, as we expect it to be. But again, nothing that brings us back very rapidly off of a $60 base, but some improvement in those out years of the forecast. Different story, as I said, on the terms of natural gas prices here in the U.S. This year, we're going to see average gas price of somewhere around $3.85 or thereabouts, up about 65% from last year's low figure. The future strip for 2026 is currently around $4.15. We're a touch below that in our forecast for spot gas prices, but we're still thinking that natural gas will be up on the order of about 20% in 2026. So this very much colors our forecast of rig activity by region. And because the oil-prone regions, I think, will struggle with their economics for yet another year, while the gas-centric areas are going to see, certainly have the wind at their backs in terms of making the numbers work with regard to per well economics. But I want to take a moment now to think about what do these underlying prices mean for the profitability of U.S. oil companies and how that affects their rate of return. So here's a slide that we've been working on for some time now that looks at, for the average E&P oil company, so U.S.-focused firm, what their return on invested capital has been versus spot oil prices, and over this 2015 to 2024 timeframe. So you might first ask, why are we just looking at 2015 to 2024? Well, we have the numbers going back to 2005, and I think we could go back to 2000 if we tried real hard. But in that earlier period, 2005 to 2014, what we found was that as oil prices rose, return on invested capital was flat to down. So we as an industry were not doing a very good job of benefiting from these higher prices. And that was in the bad old days when the industry was way overspending its cash flow. So the denominator, the invested capital number, was growing faster than returns were growing, and the industry really struggled. So at the end of 2014 was when OPEC decided it was going to fight market share battles, and so it cratered the price of oil, and that restored a lot of fiscal sensibility to the U.S. oil patch. And so since then, what we've seen in terms of this combination of oil prices and return on invested capital is shown on the chart, and it fits a very nice line with an R squared of 0.88, which is about as good as you can get in the real world. And what it basically shows, as you might expect, is that the higher oil prices improve the returns for the industry. Now, just as Richard was highlighting the advent of 4-mile laterals as driving a bunch of decisions around both on the technology side as well as on the business combination side, I think the thing that to keep in mind when we look at this chart is what's the weighted average cost of capital for your average U.S. oil company. So I'm excluding from this chart the super majors, the Exxons and Chevrons of the world. These are the ConocoPhillips, Devons, Fang, all the others. There's something like 80 companies that in this database. So weighted average cost of capital for that crowd is somewhere between 9 and 12%. Depending upon the company, the bigger ones have the lower weighted average cost of capital. The smaller ones, of course, seen as somewhat more risky, have a slightly higher weighted cost of capital, but that band is, roughly speaking, between 9 and 12%. Coincidentally, that's kind of the weighted average cost of capital for any industrial firm. So the oil patch isn't that unusual in that regard. But if you look at the y-axis over there and you find 9 and 12%, and then you track it across, what that basically, where it intersects our line of best fit, is somewhere around an oil price that ranges between $65 and, say, $70 a barrel. So in my mind, while we've often thought about or talked about what is break-even in terms of per well break-evens, what price do you need out there in Permian, or what do you need in the Anadarko, or what might you need in the Bakken to break even on those wells? I think the other important break-even in the minds of investors is what oil price does the industry need so that it's earning a return that's equal to or greater than its weighted average cost of capital. And so that's a very important break-even to keep in mind of as well. So here's where we stand then from an industry standpoint. And I think this is important to understand because this is going to drive a lot of the financial related decisions that oil companies have been taking, are taking, will be taking to try and find ways to lift their return on invested capital and above that weighted average cost of capital bogey that they're shooting for. Especially because I think it's especially important for this industry, so that whatever that they're earning their weighted average cost of capital at whatever the cyclical low point is for oil prices. So you might think today, given what we believe we understand about global oil supply, demand, and all the rest, that an oil price of around $60 might realistically represent that cyclical low for oil prices. And if that's the case, and the oil companies are not changing much in how they work, then they're below that WACC bogey target of 9 to 12%. That'd be somewhere around, historically around 4% or so, 4 or 5%, if my chart here is accurate. So. So clearly, operators in the oil patch are going to be thinking about or rethinking how they're structured, how they should be structured going forward. Can they adopt some kind of an asset-light model so they're not putting as much capital to earning the returns that they would enjoy? All those kind of things. Should they consolidate in order to achieve efficiencies of scale? All those kind of factors, I think, will be taken in light of this mindset that the senior management teams are going to be faced with. Answering the questions on the part of their investor community is, are you earning your weighted average cost of capital, and can you earn it at cyclical lows, and then how fast might it rise going forward as oil prices recover? So all things that would affect the attractiveness of the industry. I might say that we have this similar kind of chart for the super majors, and we also have it for the oilfield service firms. And these will be the kind of things that Richard and I want to talk about when we get into drill down part 2, starting next month. So stay tuned for that. Well, that being said, in terms of financial returns and hitting your financial targets for oil companies, what does that mean in terms of activity that we expect to see? Here's a chart that just sort of quickly summarizes on a global basis what we believe the industry is doing in terms of wells drilled. So the rig numbers that come to us from whatever source, Baker Hughes, Enverus, and so forth, don't count all the rigs working around the world. So I can't really do this on a global basis because they don't pick up onshore China, they don't pick up Russia, and so forth. But from a well count standpoint, we do make some estimates of what the activity numbers are in those countries. And so here we've tried to graph onshore and offshore by region. So we've got somewhere around 63,000 onshore wells being drilled globally this year. Offshore the number is offshore is around 2,500 offshore wells as best we can tell. So that represents the so we're somewhere then around 66,000 total wells are drilled around the world. China accounts for 22 or 23,000 of those. Russia is another 12,000 or thereabouts. Central Asian countries that were part of the old former Soviet Union are another 1,000 or so. So you've got 23 plus 12 plus 1, so you've got around 35 or 36,000 of these 65,000 wells. So over 50% of them are in countries that many U.S. oilfield service firms don't have ready access to. So, but something to keep in mind, because we do like to keep track of what's happening from a drilling standpoint in these areas, even though there might not be much in the way of commercial entree into those markets, just to understand what their native industries are doing and how that might affect oil production, gas production in those coming from those areas. So, for example, this year, as Russia has seen its OPEC plus quota increase under the new production scheme, drilling activity in that country is accelerated so that we understand. So that they can meet their production quota, so they can have the wells online and the volumes delivered as per the quota. Now, there's a whole host of other issues with regarding tanker transport and things like that. So, that being the case, we'll have to keep a sharp eye in order to understand what's going on in those areas. But that's the reason why we do attempt to assemble well counts on a global basis. And in the detailed tables, the Excel spreadsheets that are issued along with this report, we have country by country, wells drilled, footage drilled, spending, where we have rigs as well, split between onshore and offshore, so that you can see how the numbers break out in great detail by country, not just by region. But we want to talk about the U.S. first, because that's the one that's front of mind for most of us. Here's our estimate of rig activity this year and going forward. So in 2025, this year, rig activity in the U.S. will end up averaging just a touch under 560 average active rigs, 558 or so. We think next year it will be down, but only 2%. To this 549 number, and then grow a little bit from there as oil prices and, more importantly, gas prices stay strong. Again, our drilling forecast is now very much a regional-centric approach. We've been doing drilling forecasts now for 4 decades, and we've gone through about 5 or 6 iterations of how we go about doing the forecast for the U.S. And what has happened in particular since the pandemic, but most importantly since about 2022, is that the underlying drivers in each region have really separated. And around the time of the pandemic and so forth, pretty much every region moved in conjunction with changes in oil prices. But since then, you've seen this real dichotomy emerge where the gas-centric areas, the Marcellus, Utica, and Haynesville, and to some extent the Eagle Ford, are moving more in conjunction, or very much in conjunction, with changes in gas prices, whereas areas like the Permian, Bakken, Niobrara, and so forth are still very much linked to movement in oil prices. So with oil prices, there's some delay, and so you have to adjust for a lag in timing between movements in oil prices and rig activity. In the gas-centric areas, you really have to look at it from you have to de-seasonalize it. We have to look at annual changes, because the regional, the seasonal numbers in gas prices, as we well know, swing a lot. And so rig activity in places like the Haynesville moves more in line with changes in the annual natural gas price, rather than the monthly numbers, or the monthly numbers on a lag basis like they do for the Permian and the other oil-centric areas. So we've adopted that into our model, and that's the reason why you see some recovery in rig activity over the next couple of years, because the gas areas we think will grow fairly strongly as gas prices average over $4 a barrel for the next several years, $4 an million BTU over the next several years. We also look at frac activity, because our friends in the completion market tell us that they don't pay much attention to rig count anymore, but it's all about frac crews and frac jobs and tons of sand pumped down the hole and things like that. So activity is on the frac side has fallen again about 5 or 6%. When you just look at a job count number, we think it'll be down from a job count number down about 1% next year. if you look at it from some of the other volumetric measures like sand and water and so forth, then I think the numbers next year might actually be up 1 or 2% because frac jobs keep getting bigger, laterals keep getting longer, and so you're pumping more downhole. It's still just one job, but you're addressing more of the wellbore in doing that, and so that'll drive some of the other volumetric measures of activity in the frac area. So 15,000 new wells drilled, somewhere around 243 million feet of hole as well for next year in our forecast. And again, here's how we look at it broken down by type. So gray bars on the left are more are gas-centric numbers. You can see that we really took a hit between Q2 and Q3 of this year. Since then, things have stabilized. Given what we think we understand about where oil prices are going, we think that oil rig count number will be fairly steady going forward, maybe a touch over 400 on average next year, down about 8% year over year from the oil rig count numbers that we've enjoyed in 2025. Gas rigs, a little bit in red on the left-hand chart, as you can see, has been moving up and to the right fairly gradually but steadily. Over time. Gas rigs were up about 10% in 2025, and we think they'll be up about 20%. The year-over-year numbers will be up about 20% next year as well. So, you're seeing sort of offsetting penalties, as it were, leaving overall rig activity down just slightly for the course of the year as a whole. And on the right-hand side is our breakdown of rigs by region. And again, you'll find this in the detailed tables of our forecast. The chart that you're seeing on the right-hand side is just the horizontal rig count in these 5 major areas. I think combined, these 5 major areas account for somewhere around 80% of the horizontal rigs working here in the U.S. And then you have all the other areas which have 1 or 2 going at any one time, fairly small numbers. So places such as Anadarko or in other parts of along the Gulf Coast and so forth. So so this captures most of the activity and just paints a picture in terms of where we've seen the break happen in terms of between Q2 and Q3 this year. It really stepped down with regard to activity in the Permian. The other areas, again, oil-centric areas were down, but much less dramatically over the course of this year. Gas rig areas are continuing to grow, and we think those trends will largely then stay in place, with oil fairly stable in each of the oil-centric regions, and rig count growing in each of the gas-centric regions next year. What does that mean for those folks who sell artificial lift equipment, things that are much more driven by volumes of production rather than new wells or rigs? So, and this is getting a little tricky for all of us to try and forecast, because with the advent of longer laterals, what appears to be happening, at least as we're looking at the numbers, would suggest that initial oil production is not growing very much, but the rate of decline from these horizontal wells is not as drastic as it used to be. So when we think about trying to estimate then total production in a region, some of the old rules of thumb, some of the old relationships that we'd been using are beginning to break down, which is a long way of saying that oil production in the Permian has held up a lot better than what we thought it would, given the decline in rig activity. So it has flattened out. There's been very little growth in the gray part of the bar on the left-hand side. That's the Permian. It's basically flat year over year, and we think it will continue to be fairly flat in 2026, and not much of a decline in 2027 or 2028. Again, these longer laterals, while they're not adding much to the initial production of a new well, they are mitigating the decline rate to some degree. And so when we add up production from all the wells, it's not been falling as fast as it has tended to be in the past, which means you don't need to drill as many new wells in order to sustain output for many of these regions, right? So, and this is affecting not just the Permian and oil-producing zones, but really output from all the areas, gas as well. So because all these areas are seeing much longer laterals today than they were 2 or 3 or 5 years ago, and we would expect that lateral length will continue to increase. So this issue of new well productivity and long-term decline rates, I think, will continue to evolve in all these areas, which will make things more of a challenge to forecast regionally. Upshot will be, though, that oil production in the U.S. will stay fairly steady. Numbers of wells in production, we think, will grow slightly. On the gas side, more of a growth in terms of wells production, and of course more of a kick in terms of output as well. With pretty much all the gas areas expected to see a growth in output. Gas production in all these areas is growing. In the Permian, we see that happening as well, and in part, I should say probably entirely, the growth in the Permian, even though we're seeing oil production flatten out, because of the shift that's happening there, right? So these days, a couple of years ago, the Midland Basin part of the basin and the Delaware part of the basin saw roughly equal numbers of new wells being drilled. Today, the Delaware part of the basin is at least 55% of the new wells being drilled, maybe closer to 60% as we sit here today. So that shift going on with the Delaware, again, being much more gassy area than the eastern Midland part of the basin. So that means that associated gas per barrel of oil produced out of the Permian continues to grow, and that's why we're seeing the Permian gas numbers continue to push up and to the right. And of course, you see that confirmed in terms of the infrastructure spend happening over on the midstream side, right, where the Midland market, the Permian market, is still seeing a lot of new processing capacity, gas pipeline adds and so forth to accommodate these greater associated gas volumes coming out of the Permian. So that's there. We'll also look at costs on a quarterly basis. These are numbers from our most recent survey back at the end of Q3. We'll be updating the numbers here later on this month. Quarter-to-quarter changes have been fairly minimal. Some have been up, some have been down. Certainly the tariff issue has driven higher costs for steel-type products, and so we've seen a bit of a bump up earlier this year because of those items that are steel-centric in their input cost side. But basically, we think going forward that we'll see a bit of a moderation in upstream well costs, drilling and completion costs over the balance of next year. So we think things will be down on the order of about 1% year over year. And so the cost side of the industry, I think, will be fairly well contained. Again, these are unit costs. So when we think about, well, you've got longer wells, so you're drilling more feet, you've got a bigger frac job. So the size of the design of the job, will change and will be, if not supersized, at least bigger than what it was next year than what it's been this year. And so that might drive the overall cost of drilling and completion up slightly. But in terms of unit prices, we think those will be flat to down over the course of next year. What is happening on north of the border here? Canada has seen activity fall very, very much in line with U.S. work. So spot oil prices up there are down about 17%. Spot gas is up around 65%. So their underlying commodity movements are exactly in line with what we've seen happen here. Rig count is down about 5 or 6%. This year, and we think it'll fall in aggregate down about another 7 or so percent next year. So 163 rigs, close to 6,000 new wells drilled, close to 60 million feet of hole drilled. One of the things we've added this go around that we've not had before is an estimate of frac activity in Canada. So Frac Focus has a Canadian-centric database, and when you go through those numbers, first off, they're only providing figures for Alberta and British Columbia. So we don't have Saskatchewan in any of these figures, and that probably would add another 400 to 500 frac jobs to the total if they were there. But the figures you see on the right-hand side are just those from those two provinces, Alberta and British Columbia. And activity is, slimmed down this year as well, but we think, as in the U.S., it'll begin to stabilize and then recover over the next couple of years. The peak that we see in the data in 2023 was entirely driven, as I understand it, by the interest in operators up there to open up new wells so that they could supply gas to the LNG export terminals that have then opened up late last year, early this year. So this was in preparation for a new export market, and so that drove this temporary spike in frac job activity. So sadly, not expected to be replicated anytime soon, even though Shell Canada is gone about trying to, or will be adding to its LNG export capacity over around the 2028 timeframe, if I'm correct on that. So we may begin to see some faster than expected recovery in terms of frac activity, maybe even so on the rig side in Canada as we get a couple years down the road. But the timing of all that still remains something that needs to be determined and pinned down a little bit more closely. So international then comes with a big caveat this year, or this time around, because since we met in September, the folks at Baker Hughes have revised how they report rigs in Saudi Arabia. In the past and everywhere else, for all these years, they've reported active rigs, or rigs in all these countries, on an active rig basis. But for Saudi Arabia, they're now reporting rigs on an operated basis, meaning that they may not be drilling, but they're under contract. So that's the only country that they're doing this for now. But when they made that change, it added on the order of about 150 rigs to the Saudi Arabian numbers. And so we've incorporated that in our figures for on the international drilling forecast. The other thing is that they only then revised history going back to 2024. So we don't have comparable rig count numbers prior to 2023, or prior to 2024, I should say, given the way that rigs are being reported today. So this is a bit of a disruption in how we can go about making long-term comparisons, but you can be assured that we're using these updated Saudi numbers in our forecast from the rig side anyway. Ultimately, it hasn't made much of a change at all, really, in terms of how many wells we think are being drilled, footage being drilled, and so forth like that. But we do have the new basis for rig activity incorporated in our international numbers. So when we do all that, it looks to us as though international rig count will rise about 2% next year to somewhere just north of 1,050 rigs, somewhere just shy of 9,000 new wells, and around 65 or 66 million feet of hole. Again, these figures all exclude China, Russia, and Central Asia, where we don't really have rigs a rig count available to us. Onshore and offshore, again, same kind of thing, where we've incorporated the new Baker Hughes counts. So again, that affects both onshore and offshore in Saudi Arabia. So both data series for the international market as a whole have been affected. But what you see happening there is, again, a recovery in rig activity. As I had said earlier, now that OPEC Plus nations are trying to firm up and qualify for a higher maximum sustained production capacity number, this might begin to affect the underlying rig count and wells drilled numbers in 2026. We haven't seen any sign of that yet because the announcement is just a week old, but I think this might be a factor in select countries, probably mostly around the Middle East, where you have countries like Abu Dhabi, Kuwait, Iraq, and others who want to claim higher figures, want to be able to be given credit for higher production capacity figures so they can ramp up their actual output under production agreements a little bit higher than what they are today. So just to quickly sort of go through what we see happening in terms of regional activity, Central and South America, up about 3% next year, 139 rigs, as you see, somewhere around 1,800 new wells. In Argentina, we're seeing a bit of an impact on the Vaca Muerta because of low oil prices and higher costs. And so while there's still a lot of interest in the area and a lot of operators are moving into it, this is something that we need to keep in mind. There was an announcement just the other day, I believe, of Continental Resources acquiring some acreage in Argentina. So you're beginning to see some U.S. operators who have made their bones in the U.S. shale business, looking abroad to see what they might be able to bring to the table in places like Argentina or Abu Dhabi and some of the countries in North Africa that have shale resources that those countries are anxious to develop, but need some expertise in. So Argentina is that story. Petrobras is increasing its E&P budget slightly over the next 5-year period. It's really focusing because it has drilled so few exploration wells. I think there were only 7 exploration wells in Brazil drilled last year. So it needs to prove up some new reserves, and it's looking north in the equatorial, around the equator, to look for additional reserves it might encounter there. Europe, fairly flat. Of course, we've disappointingly seen the Labour government in the UK decide to retain its windfall profits tax. That's going to really impact longer term the CapEx budgets of operators on the UKCS. Norway is getting after operators to more quickly develop some of the many small discoveries it has, so we may see a bit of a pickup in terms of small-scale satellite field development in Norway. Africa, very much a region that's driven by exploration activity, and there's any number of countries where some of the majors are going back in and acquiring acreage so they can up their reserves figures and add to development plans. The Middle East, as I've said before, we're seeing things have stabilized this year. We're beginning to see activity move ahead. Various countries, pretty well-known story there. The other thing I think that we'll need to keep in mind is that there's a deadline coming up in just over 2 weeks. U.S. has put sanctions on Lukoil and basically said that any of its international operations will be subject to sanction, not be able to access the banking system, and so forth, so forth. So it's under pressure to sell its international assets. So these are many and varied. But the ones that are in the upstream end of the business, one of the major ones is in Iraq, where it is operating the West Qurna 2 oil field. And you have outfits like Exxon and Chevron and some others looking to that it may purchase Lukoil's interest in that area. So you could have some major changes in operatorships in select areas as Lukoil's forced to make these sales. And I think if that's the case, then it'll be some very interesting CapEx decisions on the part of the new buyers to what they want to do with their new toys. And Asia Pacific, we think in aggregate will be up about 3% next year. This is a gas-centric area. There's a lot of interest in proving up their domestic reserves to supply the growth in domestic markets, and we think that will continue to be the story driving activity next year. So with that, let us turn our attention in the time available to us to any questions that might have come in. So I will reintroduce Richard Spears to the audience. Glad to see you back, Rich.
All right, so so Dave sends in a question that echoes 2 of the questions I got yesterday at the Petroleum Club in Houston, and that is, there's been a recent rally in offshore drillers, the valuation of offshore drilling contractors, and is this a new exploration cycle that is starting, particularly offshore?
Yeah. So it was maybe, a couple of years ago now, right, when the New York guys looked at the offshore drillers and said, day rates are rising. We're finally putting more rigs back to work. Some of these companies had put their balance sheets back in order. They weren't so debt-centric. And so there was a rally in prices. And then interestingly enough, for the past 12 to maybe 18 months, many of those stock prices for offshore drillers have fallen, right? Because as it turned out, the yes, they were putting rigs back to work, but there was a tremendous amount of capital needed to bring those offshore units up to snuff before they could, start catching jobs. They'd been, warm stacked for a long time, right? And so there just wasn't much money, cash flow going back to investors. So some of the enthusiasm went away, and but if there's a rally now, what that really might reflect is that, these rigs will stay active. We no longer have quite as much in terms of capex needed to remarket these rigs, and so finally investors might begin to see something back to them in terms of whether it's stock buybacks or dividends or whatnot. So I don't know that it necessarily reflects underlying growth in activity, as it's just sort of the capital cycle within some of these drillers, offshore drillers. That's how I'd say it. Mm-hmm.
Let's stay in the, because yours is essentially not necessarily exploration, but we're focusing on efficiency of the industry.
Yes.
So here's another efficiency question that,
Yeah.
again, got it yesterday. People are asking about it, and here's some metrics. 2018 in the United States, hydraulic fracturing.
Yeah.
The industry per quarter spent $7 billion
Okay.
hydraulically fracturing 30 million feet of rock.
Okay. There you go.
Today, per quarter, 3.5 billion fracking 30 million feet of rock. Same amount of rock, half the dollars being spent to frack.
Yeah. Right.
And so the question is, how much of that is efficiency and how much of that is pricing? And I'm going to give you my answer.
First off, about the $7 billion and the $3.5 billion, is that total spend for the job? So sand, chems, pumps,
this is the ticket that this is a check that you would write to Liberty, Nextier, Halliburton, ProFrac. This is the check. That, assuming that they brought sand out, they brought chemicals out.
Yeah, okay.
It doesn't include the water. It doesn't include the diesel fuel.
Okay, right.
But this is a revenue dollar to the frac service
But
company.
it doesn't assume that the oil companies are necessarily buying the sand direct, and so it's not on that ticket. Yeah.
Wait, it is if it's consumed in the process, but it's not water.
I understand. Got it. Okay. Got it. Okay. So half the revenue, our hats off.
To do the same amount of cracking the rock open.
Yeah. By hats off, I mean like, sad to, we miss you so much.
My answer is that, you showed your pricing chart a little while ago, and it's been very, very flat for several years.
You're right. And that was aggregate, but the frac side, Mm-hmm.
But if you back up to 2018, prices were higher.
Yeah.
Today, it hasn't been, that the price of a thing in the oil field hasn't really changed all that much for a long time.
Yeah.
And so I look at it and say almost all of that, slash it in half, is efficiency based.
Yeah, because how many how many stages were we pumping, 2018 per day? I mean, or per quarter, maybe that's
well, how about a frac crew in 2018 was like 4 stages a day.
Yeah.
Today the average is, something like 10 or 12.
Yeah,
and
so,
some it's just higher than that.
Yeah. So so the assets are being employed. Yeah, very much so.
So do you think that the efficiency can keep going? Because I've got a drilling related question.
Well, I would
from
be
yesterday.
very much surprised that we could see that same kind of trend line extended. I think at some point you get an irreducible efficiency number.
So we're going to call it terminal velocity, because the question I got, again, it was yesterday, but I hear it all the time. Because I said, when we talked about a 4-mile lateral and the fact that, I had Paul Pastusic yesterday, formerly of Exxon, Mr. Drilling Engineer, 430 feet per hour drilling speed that they were able to hit on one drilling rig at one time.
Yeah.
But it was an exceptional speed, but today's exceptional speed becomes
string
tomorrow's
of pipe
standard.
every 15 minutes. Wow.
Yeah, it just and I said, the limit is how fast is gravity.
Yeah.
Like how fast can you drop into the hole?
Yeah.
But there was a question: can there be? This is really specific to sort of North America, where you just drill like crazy all the time. Is there a limit to drilling speeds and lateral lengths?
Oh, lateral lengths, maybe not so much, but drilling speeds.
Yeah, feet per hour, feet per day.
So that's a tricky question, because the more you're drilling in the zone,
Yeah.
you're right. That's the fastest. Those are the fastest
Sure,
feet to drill, right?
Sure seems to be, because
So
it's
you're getting more of a percentage in your most efficient, your more quickly. So yes, you could see drilling speeds continue to grow. I think just for that phenomenon. Yeah. Now,
Right.
absent, do you start drilling zone, tertiary, second, third tier zones that might have, some difference in rigs in speeds, but I think everything else being equal.
Well, there was another question yesterday, which was, does a 4-mile lateral and all the stimulation that goes with it, the way we're drilling them,
Yep.
does it actually take what we've been considering as tier 2 and tier 3 rock, actually just make it tier 1? Because of the way we've mechanically addressed it.
So we upgrade those that we promote it, right?
Yeah.
So tier 2 has
Right.
now been promoted to tier 1 because we can get at it at a lower
Yeah.
cost than we could
Yeah.
in the old days. That's why we considered it tier 2, right?
That's right.
Yeah. I mean, it had maybe a lower productivity, but again, if you're addressing it with more efficient ways.
Clearly, there's
Yeah,
better
sure.
rock than others.
Yeah.
But, already, even in tier 1 rock, the way we complete them,
Yeah.
we're still only getting, 10% of the oil out of the ground. So it's just not very much.
Yeah, right. So do you change that number in any material way?
Yeah.
If we applied current technology, maybe not so much, but it does make it lower that break even. Now, I will still say, so again, back to that chart where I was doing weighted average cost of capital and so forth.
Yep. I
again-
showed that chart yesterday, by the way.
Yeah.
And I've got a question about that one.
Okay, let's
go
hear
ahead.
it. Well, I'm just saying, that efficiency improvements is one way to address, for an operator to address, being able to raise its return on invested capital, right? And so that it can match whatever the investor community is going to demand that it reach.
So here's the related
Yeah.
question.
Mhm.
That particular chart,
Yeah.
which was slide 3 or 4 in
Right.
your deck,
Mhm.
it was slide number 2 or 3 in my deck yesterday.
Of
was
course. Yeah.
So it shows effectively no incentive to drill in the U.S. at $55 or below, because the return on invested capital is 0%.
Well,
I'm simplifying my question
sure,
here.
right. Uh-huh.
And yet,
Yeah.
drilling still happens.
Yes.
So
Yeah.
why does drilling still happen?
Well, because if
RO
you don't
price-
drill, right, then your volume numbers. So think of it this way: any business has a fixed cost and a variable cost component to it, right? And so your revenue figures, begin to show a return only if you get above the fixed cost. I've got to have so many guys out there working and whatnot, and so if you don't drill, volumes go down, revenues go down. So now you're getting to the dangerously close to the point where you're not going to be able to meet your fixed costs. And if that's the case, now your return on capital is going to go to zero, right? Or
or whatever that
sink,
is.
right?
Everything's negative.
Yeah. So that's the incentive to drill from a replacement to maintain output. Yeah, I would agree with the point that there's not much incentive to grow, and in fact, I'm sure your average investor would look at any company who's not making its WACC target and say, why are you trying to grow production when you're not making the return that we want on capital? So stop spending money, which is again why the industry is now plowing back whatever it is, 65-70% of free cash flow instead of 125% of free cash flow back in 2018.
You're right.
So.
I don't ever really want to return to those days.
Yeah.
And if we do, everything's
that's
for
a very
sale.
good point. You were talking about $7 billion and $3.5 billion from 2018 to 2025. The plowback ratio was really 120% back then, and it's 60% now. So plowback's fallen just in line with that frac service or that frac spend figure.
Here's a
Interestingly enough.
consolidation question.
Yeah. Mhm.
2026
Yeah.
versus 2025.
Okay. Right.
Do you think that in 2026, how will E&P consolidation compare to the current year, and oilfield service company consolidation compare to the current year?
Well, I think the trend for on the oil company side is maybe more deals, more but smaller deals, right? So does total dollars, I mean, there's a lot of different ways people would track M&A work, and you might think of it in terms of total spend, and those numbers might be down, but there actually might be more deals done as outfits, spin off. What do they call it?
Spin-off things that don't
non-core
fit.
areas, right? Yeah, that kind of
Yeah.
thing. Because again, if it's all about contiguous acreage, right, and I'm buying you, but you got some acreage over there that ain't contiguous with anything I got, then goodbye, right?
Like, I've just acquired you, and tomorrow,
Right, yeah.
that's for sale.
That's for sale, absolutely, and we've seen that in
So
some
that's
deals right
so.
away.
I don't know if you call that consolidation, but it's the transactions that occur as a result of a consolidation. And I would love to be an investment banker during this era.
Clearly, the transactions on the oil company side that are going to happen are all about optimizing their portfolio of assets of acreage, so that they can again raise their return on capital.
So we over on the service side, where we've just traditionally done, I don't know how many hundreds or thousands of M&A transactions we've supported over the decades, but and there's still a few going on.
Yeah.
But how would you categorize? Because you've been the one who's been doing most of the M&A related stuff on the service side. What sectors are those that have been happening in the current year?
Yeah, it's infrastructure plays, right? So it's compression, right? Part of that's just how some of the private equity guys are defining what their portfolio is going to go after, not energy, but infrastructure. But again, a lot of the deals that are happening there are between strategics, right? So you have one player one buying player five in that market, and so it's not really private equity coming in like we used to think about it. I think around that, to the extent we get private equity deals, we're going to see more that are sort of driven by software and AI things. How can those companies that have a product that can help an operator do better? So it's going to not necessarily, in my mind, be the traditional directional drilling frac company, those kind of things. It's going to be folks that are more software, database type firms, I think, where we'll see deals that involve private equity.
I'm having a private equity call this afternoon related to a software related thing, and I'm fascinated to see discover what this covers.
What's going on there? Yeah. So again, all about can we mine, and that's going to be a thing. I think the stats I saw in a survey of industries in general was that the oil patch came back and said about 8% of the companies thought that over the coming year that they would make more use of AI in their operations. What type of operations that might be is who knows. Maybe it's just hiring people, doing a better job of hiring those folks. So you get a higher quality, candidate in the door, as opposed to redesigning how you frack a well. So
we are somewhat partnered with a Bitcoin related media company. Yeah, and I know that AI plays a gigantic role in understanding the massive amounts of data that comes from there. But I still look at at drilling a hole in the ground, or fracturing a hole in the ground, and even though, like my friends at Cold Bore in Calgary can measure 1 billion data points during a frac job over the 4-well pad over a month, I just wonder if the people who are using those data points are really only looking at like 10. or
your bandwidth is not expanded as fast. Hey, tell the crowd what a drawer frac was.
What a drawer, I think we still do. Yeah. But back when I was a Halliburton frac engineer, we get the call come in from a guy that says, I want you to frac my well, and I'd go, where is it? Yeah. And then I would go, here's the coordinates, here's the county, here's the depth, and I would get in my drawer. Yeah. And I'd open the drawer and pull out the 3x5 index card to see what I'd fracked on the well across the road from it, the drawer frack. Yeah, right. And that's what we did. So that's the incredible design work that I did during a frack job.
My point there would be that was optimized for its day, right? You had something,
it was easy for me to do.
It had worked. You were very efficient. I don't have to redesign the well. I don't have more engineering time. I've done it already. I'm going to go out and apply it. So you think about where the optimization occurs in the process. Is it in the design process? Is it in the execution side of things?
And now it's the execution side. Yeah. Okay, so here's a question. Okay, do you see operators trying to gain any significant EUR from refracs and well workover intervention? Great question.
You're right.
So, do it again.
Right. What you've estimated? Here in the U.S. we do about 500 refracts a year, something like that.
That's a guess. So 500 out of 11,000 frac jobs.
Yeah, something like that.
But I'll tell you what, I have this nanoparticle company, and some of its biggest future work is going to be related to re-stimulation of existing well bores.
Yep.
So, people are trying all sorts of interesting things. Always will, always have.
Yeah.
But it's hard to argue with the fact that we leave most of the hydrocarbon in the rock.
You would think that would be a big target, right?
You bet.
Can you get at it, though, is the key, because where did that old fracture go, and how can I avoid it, right? Because that's the refrac. You don't want to refrac your old zones.
And most of my current focus on my family's investments is on trying to figure out what is that thing that causes EUR or production from an individual well or field to rise by at least 30%. And that's where I'm going, because that's the material change in the industry that I'm going to try to.
One of the challenges though is where was that old frac? Where is it located?
Where did it go?
Where was it initiated? Yeah, and where did it go? Right. So where did it go? And you think about how do you determine that? That is going to be that may be the limiting factor in terms of how fast refrac activity can go. Because I think the things you can do can be shown to be very effective. But
at what cost?
But we're right.
All right, I think this is going to be the last question. So it's going to be drilling speeds in the U.S. Are approaching max theoretical performance. So what we sort of talked about a bit. Focus should be on life cycle value
improvement. Life cycle value improvement. Okay, so over the course of that life of that well, it's what you were just talking about in terms of.
So let me ask you a question. Given this, in the life of a newly drilled well today, in the first 3 years, how much of the ultimately recovered value from that well happens versus years 4 through 50
and beyond?
Yeah.
Oh man, I actually tried to do that calculation under different kinds of lift.
Lift
things,
techniques.
Right? Yeah. But it's well over half in the first 3 years, right? So
and by well over half, you don't mean 51%. You mean 75%.
Yeah, something like that. If roughly speaking, year 1 you can say is really flowing, right? Year 2 is the first type of artificial lift.
Yeah, it's going to be a little earlier than that, but
And then maybe in year 10 you now go to gas lift or something like that, right?
I think it's way earlier than that.
But the point is that it evolves, and that helps extend the life. But just in terms of raw barrels or feet or whatnot, you're thinking 2/3 to 3/4 got to be the first 3 years or so. And an operator wants that, right? I mean, he loves to have.
It's a very steady income if you can keep your operating costs below. The revenue you get out of this crazy thing. But I'm going, if the majority of your revenue very profitably comes out of the well in the first 1,000 days, that's where all my focus is going to be. And I'll let somebody else worry about day 1,001.
Sure, yeah.
Because by then, if I'm a small company trying to build my business, I may not own that well anymore.
Not to take issue with the question, because it's a very good question, but I think it needs to be couched in terms of, if I'm an operator here in the U.S. and I look at my shale operations and say, we've been doing this for 20 years now, right?
Yeah.
We are pretty close, whether it's couched in terms of max theoretical drilling speeds or very mature areas where we've drilled the first million wells. Now I think the question becomes, is there a way to improve the life cycle of that type of operation, or do I just go someplace else? Do I leave the U.S. and now go abroad? And am I a Hess that happens to invest in Guyana alongside Chevron, or am I a Continental Resource who's picking up acreage in Argentina or was it Turkey?
Turkey,
I think, that kind of thing. Yeah,
Turkey now.
So I think that's the issue. It's not just sort of how we do and can we get better at it here within the U.S. It has to be couched in terms of what are my global opportunities here, and am I big enough to go, hang with those guys, or do I stay focused on what I can do here locally? So
I'm just wondering about the American or the Texas oil and gas folks who are going over to manage Turkish drilling rigs now. Good luck, guys. And I do know one guy who's on a Turkish drilling rig right now.
Yeah.
And I'm going. And his comment was, "Everything works good as long as you got the teapot on and ready to go." The samovar's fired up.
The Permian has spoiled us in terms of the pace of activity, which operators and service firms alike can achieve, right? And you just don't see that anywhere else
on the planet.
And so if that's the mindset you're trying to achieve, fine, but it ain't going to happen, between now and Thursday. So
that's right. And I don't even know what Thursday and what year. John, I think we're out of time. In fact, we're over.
Yeah.
So
we will say goodbye. We'll be doing this again come March, and of course we'll be starting up the drill down part 2 in January, which we will certainly send notices to folks about, because our focus will again be upstream and this part of the oil patch that we love the most.
Are we going to bring back the puzzler?
We might. We have to figure out what
Like
we know what find the answers are. All things old are getting new again. Thanks so much, folks, and we'll be talking to you.